But for more on this, Lauren, we want you to stick around. But also we want Gary Hager from Integrated Wealth Management and Ron Davari from NewOak Capital to chime in on this. Super busy week, although, you know, markets closed today, so there might not be very much action today. But this is a day where we can look ahead and try to plan out what to watch for. Lauren just detailed out a lot of the earnings out. What do we look for, Gary, as far as the earnings? So far, we've seen strong numbers, but not a huge market reaction. We were talking about the markets earlier. You said it's actually good that we're sort of moving sideways here.
Yeah, because, you know, as I stated, the market's had a V-shaped recovery so far. Too far, too fast, just like on the downside. And you have to have a pause that refreshes, whether it's, I mean, my preference would be the sell-off, which we got from 10.7 down to around 9,800 intraday. We got closer to 200-day moving average. Some people looked at it as a correction that was waiting to happen.
So you're okay if we don't necessarily just rally from here. You like to see it level out a little bit.
I want to see a little more blood in the water. I want to see people be scared still. You know, one of the things that Buffett has taught everybody in regards to contrarian theory is you buy when they're selling and you sell when they're buying. I believe it, and I still think, and I called earlier on in the year that this was going to be an 8 to 15% year-up year, but not without increased volatility. I think the VIX has been running low for a while, and it's probably going to break out to the upside.
But that doesn't make this a market for the faint-hearted. That makes it very volatile.
When has it ever been?
Well, and this is true, but, you know, we had a very successful straight-up year in 2009. So 2010 is going to be a little bit harder to read. Ron, some of the individual names that we're looking at, Walmart, Kraft, what are you looking for this week?
I think they're going to be in line or slightly better because, you know, obviously they have a good beta to the economy, and they're very, you know, big companies, global. They have so they benefit from global growth. So, and they probably have been a little bit conservative on their numbers. But, you know, back to the stock market though, I really caution folks because we are really at a transition point. The key is the direction of interest rates, and when that changes, when
when there's any sign that the monetary policy will
and the
change.
Stimulus go away,
yeah.
And you know now we're, you know, the stock market led this obviously the change in sentiment in the consumer, and the question is, would the momentum stop if the stock market goes sideways, and perhaps you get some short selling if people are trying to essentially you know, lock in their gains, and if that, so we are going to see this, I think, this push and pull for a while, in my view.
I want to bring Lauren back in because Lauren spends every morning on the floor of the New York Stock Exchange, the early hours. And what's sort of the tone that you've been hearing from the traders down there? Is it going to turn to watching the Fed for every little hint that they might start, when they're going to start raising rates? Is it?
I think it's baked in the cake. I think everybody knows that monetary policy is going to tighten. They're saying by about June. So they think that that's going to happen. Consensus is stocks aren't going to do so well by the end of the year. That's the consensus.
All right, Gary, what do you think?
You're wrong.
You're very positive. You're very bullish. You're very...
I told you where the macro side comes from.
Yeah.
It's all based in political. You've got the Democrats with a very tenuous hold on the House and Congress and Senate. You've got a fortune of money back in TARP. You've got stimulus money still not being paid. And you've got this very feeble, lukewarm jobs bill that was proposed, $30 billion, that's going to do virtually nothing, with the design that by mid-end of summer, early, not even into September, you're going to see some very robust numbers coming out. You're not going to see Fed changing until then, and you're going to see the Democrats hold on to a lot more than what people are expecting right now because they're timing it just perfectly.
All right, Ron, Gary, Lauren, thank you so much, you guys. So lots to look for.
So let's talk a little bit more about what Toyota has in front of them, the road ahead, if you will. Gary Hager, Ron Davari back with us. So we're going to hear from them on Wednesday. They say the electronic system is no big deal, because everything's all right. Maybe we'll see some incentives to get people buying these cars again. I mean, what do you think their biggest challenge is from this point forward, Gary?
Trust.
Yeah.
That's straight up. I mean,
so is that fixed by like a longer warranty, for example, if they offer their new buy or something like that?
No, not when people die necessarily because a brake pedal or a accelerator pedal sticks.
Right.
So I think they've got a real big PR problem on their hands that GM, Chrysler, Ford couldn't have asked for a better Valentine's Day present.
How do you think they can fix that? Is it time?
It's time.
Yeah.
Yeah, it's time. I mean, they've got the great PR machine. I mean, they've done it right all the time. Even their commercials that they brought out, which talked about all their years of serving the world economies, the vehicles they've had, and how quickly they're supposedly acting on this. I mean, they'll come out of it, but I think this is GM and Ford's opportunity to really pounce on this, and they are.
You think they are?
Oh, yeah, absolutely.
Ron,
this is a great opportunity.
What do you think?
I think this is a big issue for Toyota. Toyota got ahead of the American car manufacturers using quality as being their ace in the hole, and now this is coming back to them. So they're, through their own growth and becoming such a global force in auto manufacturing, they're finding their own problems. So,
you know, it's interesting. We saw Japan grow at a rate that maybe some weren't expecting. We saw their GDP growth today. Some say is going to keep them from going into a double-dip recession. So is this the story about Japan? Are we overplaying it? I mean, are we overplaying the story on Toyota and what they have or don't have ahead of them, or what Japan has or does or not have?
Obviously, the market players in Japan today are looking at China, not at Japan itself. I think it's okay to look backward, but all these economic data that are coming, they're sort of an indication of what happened in the past. And it really hinges on the stimulus that was provided by the Chinese really going out and spending and providing a lot of cheap credit. Now we're hearing that that may not go on forever. We're hearing also the budget deficit issues globally. Greece is the first to start having problems. So I think we're getting, I believe we are at the inflection point. What really pulled us out of this, what I consider the major recession in 50 years, now has to be dealt with in a real way, which is, with austerity, and we can't really deal with that so well. So we have to.
Why can't we?
We just can't, because we were expecting the engine will start. We're going to, so that nobody will, and the growth will mask our budget deficit, and the governments will be happy. But there's a lead lag issue, and I think right now we're dealing with that lead lag, and I think it's coming back into the governments, and the governments are finding themselves they can't act irresponsibly forever.
And it's interesting, Gary, because we're almost talking about a lead lag issue with Toyota. What they're leading with, what's going to be the residual effects. But it does seem to be that's a common theme for companies and this market about, what are the leading indicators? What's going to be the lag effect? How do you bring and reconcile those two things if you're an investor? How do you do that?
Well, I think that whenever something like this occurs to a powerful company, it's normally an opportunity to buy.
That company specifically?
Absolutely.
So where's Toyota trading right now? Let me just look at that. I mean, Toyota's trading at like $77 last close.
What's 52-week high?
It might be. Let me see. This is. It's not showing the current data since it's coming off a weekend. This is, the ADR that we're looking at here. But it was up on Friday, up 17% over the last 52 weeks. It was touching close to those levels.
Okay.
We've heard some people say, start buying around 65 or something like that.
I haven't looked specifically at Toyota from the technical side, but strictly fundamental. When you get a hit like this, when the company is being bashed from all sides, it's typically an opportunity, again, assuming you figure Toyota is going to be around, and I do, that they would be an opportunity to buy that stock on weakness. Is that true? Countries too?
I mean, is that true, buying into a country?
Well, we heard a few large asset managers really jumped ahead. It was a Bloomberg headline and bought the Greece debt, and they said to compare that, this is no Lehman. And we believe this is not an issue. I think this has become a big problem of moral hazard. Even our very sophisticated investors are using the moral hazard as a way of investing, and that's not really true investing. That is, to me, being technical investing, which is okay if you can make money.
Is that what you're doing, Gary?
Always. But the other side of it is, I think Toyota, from their own perspective, as they are to study the art of Sun Tzu and the art of war, which is going to be to say, what can we bring out quicker, what in our pipeline as they set up their releases for 11 and 12 and 13. I have a feeling Toyota's got something hidden in their pocket for the next auto show that's going to all of a sudden say to people, hey, wait, let's take a look at Toyota. The new hybrid they've got is now averaging 47 miles or 50 miles
We're actually going to turn to an auto show that we're watching next. Gary, Ron, thank you very much.